disclaimer, this is for education. I'm a lawyer. I'm not your lawyer unless I am. So please take this education, take this information, and make sure that you're always getting advice from a professional that can help you get your business launched without taking on the regulatory risk or liabilities of not doing it right. To start with, today we're going to talk all about private equity funds, PE funds. What this usually means is, hey, we've set up a blind pool. We've set up a bucket where money goes in, and then it's acquiring multiple assets underneath it that all the investors will participate in and have a benefit in everything that the equity fund is doing. In terms of the type of targeted investments that equity funds tend to do, stock in other companies, if they're public, you all know them. Mutual funds, they're equity funds. Oftentimes, these equity funds invest through special purpose entities. I'll talk a little bit more about those, but generally, you have a pooled investment vehicle that will own 100% of these special purpose entities, and then other businesses or other real estate opportunities are acquired through that. Oftentimes, it's a requirement of financing. There's benefits in other areas as well. Now, if you're doing an equity fund, everybody comes to the table and says, well, I want to be able to buy anything, do anything, anywhere in America or the world. And you know what? That's actually perfectly legal to do. But when somebody comes to the table and tells me this, I'm asking about their background, their audience, and how they expect to fund their equity investment. The reason being, it is difficult to talk investors out of their money into an investment without being able to tell the investors, this is what we're targeting and this is what we're doing. Some people can still do that and be quite successful at it. But in a general sense, we're often advising people to shrink that targeted acquisition box. And so what I may mean by that is, it's easy to say, we're going to do a real estate fund. Well, where are you going to buy the property? Well, I'm in Texas, so maybe Texas, Louisiana, Oklahoma. I'm definitely not going to go out to California or Maine because the properties are just too far away. So great. Let's shrink that target market to the mid-South Texas. And what kind of properties are you going to be buying? Well, I don't know. I may pick up some rental properties, some multifamily properties, some ground up development, but I'm here to say that oftentimes investors have a certain risk tolerance or a scope that they're okay with investing in. And as an example, with multifamily or with rental portfolios or built commercial property, they're generally already have tenants. They're generally already paying cash flows. Those have a lower risk profile than a rehab project where you're buying into a property that is only partially leased out, or it's unstabilized, or it requires a ton of improvements. Higher risk, higher reward, as long as you, the operator and sponsor, can get that property up to that level that now it's stabilized. And then an even higher risk profile, higher reward, ground up development. Just buying raw land for the purposes of building buildings for whatever makes sense for the area and leasing or selling them out. Higher risk, higher reward. So when somebody comes to me and says, I'm thinking about investing in real estate and I want to set up a fund to do it, I'm also asking them about, well, what have you done in the past? And if your experience is in buying multifamily or apartment deals that have been stabilized, we'll want to stick to that scope of the investment, maybe expand it to rehab opportunities or Class C apartments that have the upside benefits of, with a little bit of cost, with a little bit of expense and love, it becomes a Class B or even a Class A property. But I'm always encouraging people to limit what they are targeting for the specific reason that investors expect it. And really, if you're talking to an investor, it's what they're interested in, and their risk profile is really one of the most important things to consider in putting together your real estate fund. Why even do an equity fund? We work with a lot of real estate syndicators or, entrepreneurs that will do funding round after funding round, different asset versus different asset. We call it a syndication model. With those, it's a brand new entity, brand new investment that's happening every time there's a new asset. And there's great reasons to do it. The number one is that you're building that confidence and expectation with the investors that are not just looking at the what have you done for me lately. They're considering the demographics of the property, the specifics of that property. The focus is less on the operator and more so on that property opportunity. Now, if you're looking to do an equity fund, though, really there's a great benefit that as you're raising the capital, you can act quickly for the opportunities. When it comes up, you have the cash, you move forward. It's not about setting up a new whole structure in order to market to, pitch, and promote it to new investors. You're already working on your investor base. Secondarily, funds allow for a diversity of the investments. So to use that same example, if you were a syndicator and we'll say you're targeting 123 Smith Street, fantastic. You do a syndication, you get it funded, you get it closed. It doesn't go well. Now there's a foreclosure. The investment is lost. The investors lose 100%. It's over with. Now, if you had done the exact same deal through an equity fund, and 123 Smith Street is just one of 10 different properties, as an example, and this one property gets foreclosed on, that's okay. I mean, it's never a great thing, but you haven't lost 100%. Now you've only lost what's been invested in the one property. You got 9 more to make up for those losses and still get a great return. Fantastic reason why you should do an equity fund. And ultimately, if you ask me, I'm an entrepreneur. You're an entrepreneur. If you still have your W-2 job, this is a whole new business. There's management fees and carries to build that legacy wealth. But it's a great way to leverage your time so you get off that hamster wheel that you're capped with. How many hours a day can you work? What's your salary at? Which isn't adjusting by 2x, 3x. You can accomplish all of this by doing your own equity fund, still focused on your own business, your own growth, focusing on your family's wealth and generational wealth.